Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we are discussing where is the best market to buy in 2025. Before we get into that, before I show you some key markets where we're buying, we will run through the 18-year land cycle briefly. As you are probably already aware, the 18-year land cycle we use as a framework. We use it to study history, as we can use the history and data correlation together with sales data to work out which market is primed for growth in the future years ahead. We are on the blue marker, roughly a year and a half, 2 years away from the peak of the market before the market will top out, and then we'll go through the next land-driven downturn, also known as previously the 2008-9 GFC and the 1991 recession we had to have. So buying property now is critical to get the right market right, because we're going to go through some very volatile times ahead. So in the first half of the cycle, Sydney, Melbourne outperform. And then in the second half of the cycle, Brisbane, Perth, Adelaide outperform and their respective regions. And New South Wales, Victoria regions have a flow-on effect from Sydney and Melbourne around the midpoint of the cycle. And as we reach the peak, everything tops out and then resets, and then Sydney, Melbourne then start to lead again. So with that framework in mind, we are in a similar point of the cycle of 2005. So I'll show you the markets we are currently buying in every day of the week. And you may be thinking, well, Geordie, if we're due for a massive downturn, shouldn't you wait and then start buying then? That's not right, because not every market performs in correlation with the 18-year land cycle. Not every asset performs, whether it's a unit, a townhouse, a house, a block of units, commercial assets, crypto, stocks, shares, everything performs differently. We use history and the underlying rhythm of the cycle to understand where we sit in the market. It's called the 18-year land cycle, but it is also known as the business cycle, because every type of asset, every market performs in its own rhythm, on its own race. So if you know history, if you know where we sit in the market, you can see where individual assets in markets will perform in the future years ahead. So we are in a similar point of the cycle in 2005, a couple of years away from the 2007 peak, where we'll go through the next land-driven downturn. So with that in mind, we'll run through some key graphs where we're buying in. So first one, I've redacted them. Obviously, I'm a buyer's agent. If you want help buying this type of stuff, reach out. I'll put my details in the comments below. We use this obviously as a framework. This is where we're buying. And as you can see, this market is pretty solid. Doesn't have too many booms or busts. It just continues to carry on. Solid markets we like to invest in using the cycle. So as you can see, we're in 2025, but the similar point of the cycle is 2005, and it is set for its next significant growth run in the years ahead. So as you can see, the medium value for this market is around 600,000. And in 2005 and onwards, it commenced a significant bull run from 2005 all the way up to 2017, with only 1 year being 2011, where it retraced 11.5%, but the following year it regained that loss. So this is where we like to run these reports, work out which markets are set for their next growth run, and buy before the herd. So it's not always the markets that are going gangbusters you want to get into. It's more so the dark horses in the background that are the winners. It's like backing a horse race. You're not going to back the horse that's leading as soon as the gun goes. and is firing out of the gate, as it will more than likely burn out and gas out. The horse that usually wins is a horse that's in the mid pack, and it comes good towards the end of the race and it paces itself. So this is a similar market that we're looking to buy in now, and we have been buying in this market because as you can see, similar point of the cycle in 2005, look at the strong growth it had in the years ahead. So that's the first one. Second one, where we're buying currently now, again, there is a bit of a, hasn't quite hit its bull run yet. It's not mainstream, this area, but come 2 or 3 years, it'll start its growth run, and then it will go gangbusters, and then every man and his dog will be rushing in like they're doing so to Brisbane, Perth, Adelaide, Townsville. Townsville seems to be the hot topic these days. So that is not where we're buying. We're buying in the more subdued markets where days on market are higher. That's where you want to get into when you can negotiate cracking deals. As you can see again, in 2005 and onwards, it had a strong run, this market, with only 2011, a 4% decline, which was regained the couple of years after, and again, a slowdown in 2014 of 3.9%, but the following year was regained and it continued on. So this is the growth patterns we like to find. Solid, ongoing capital growth that cash flow. We are all about a combination of cash flow and growth. So we're not all for growth, and we're not all for cash flow. You need a mixture of both. You need the capital growth to allow you to keep leveraging the growth from one deal into the next to keep building and growing your sustainable portfolio. But then you also need cash flow to allow you to stay in the game and allow the bank to keep lending you more money so you can build a self-sufficient property portfolio. Don't go chase cash flow and go out to the Boondocks, Broken Hill, Townsville. Everyone's chasing cash flow because those markets will switch off when we go through the next land-driven downturn, and you'll be left hanging for many years with a property in negative equity. On the other side of the coin, don't go out and buy a Bondi Beach, Tamarama, a Manly supposed blue chip property that's going to have supposed growth, because those markets go through protracted 8 to 10 years of stagnant growth like they've already started now, and then they go through solid bull runs. We like to find markets that consistently have ongoing capital growth and cash flow. As you can see, these markets have the medium asking price, 450, and the medium value, 433. So as an example for this, and this is the medium. I mean, we pick up deals for 100 to 150, 200,000 less than the medium. So we get cracking deals, pre-market, off-market, coming to market. I get calls every day of the week from agents when deals fall through. They know who to call. They know me to call me because I got buyers and backup buyers. Real estate agents are a transaction business. They want quick deals that go through. They don't care if they sell it to me for 50, 100 grand less, because a bird in the hand is worth more than two in the bush to a sales agent. They want deals going through quickly and not getting mucked around by first home buyers or investors who get cold feet over smelly carpet. They'd rather sell it to me as I vet the buyers. The buyers are ready. The buyers are cash buyers. Buyers are on board looking to buy multiple deals. That's why I get the great deals. When you can buy in bulk, you get great deals. So 450 times 52 divided by 436,000 for the medium. So this is the medium. Me asking rent with the medium, but we're picking up, so that's 5%, 5% for the medium, but we're picking up deals for 100 grand less than the medium. So we get typically 6.5 to 7% yields on day one. So that's solid cash flow and solid capital growth that we target. You need a combination of both. Next one, next market we're looking at, and we've been buying in. As you can see, solid, consistent capital growth. No real downturns at all, other than a year or two here or there. But every market needs to take a breath at some stage. But we steer away from the markets that go through protracted 10, 15 years of negative growth, like the Perths, like the regions way up in regional Townsville. Run these reports and look at Townsville. It went back 15 odd years. Who wants to buy a property that goes backwards for 15 years? I don't know about you, but definitely not me. So here's another market we're buying in that's softened this year. The days on market are high, which is good. Good to get in when stuff is sitting around because you can get good deals. And then look at the growth that this market had from 2005 onwards. Continued to go, had a bit of a slowdown, not much, 3% dip in 2011, 2012, 2013, recouped that, and away she went consistently. Solid capital growth and cash flow. It's a combination of both. You need both. Can't just buy property in isolation. Do not chase one or the other. You need a combination of both. And there's only a handful of suburbs in the whole Australian market that I'd buy in right now, because once the market turns in 27, 28, a lot of people are going to get burnt and they'll learn the hard way. They're chasing cash flow. They're chasing high yielding residential. They're chasing commercial. When the market turns, those markets will soften in residential. They go backwards for 10 plus years. Commercial assets, 50% probability of losing your tenant. If you lose your tenant, your commercial asset will be only worth land value. And it'll take you 3 to 4 years to get a new tenant in the next land-driven downturn. If you don't have a solid residential foundation portfolio or a shitload of cash in the bank to support that, paying the mortgage, interest to the bank, rates, upkeep, land tax, all that in your commercial asset, if you can't pay for that, the bank will be selling it for the debt that's left owing to the next person. And if you're negative equity, well then hopefully you don't get wiped out. So now's not the time to be chasing high cash flow or commercial property because the market is about to turn. You want a combination of both. Solid residential foundation portfolio is what we specialize in. Affordable accommodation. When the market turns, there's a shift to affordable accommodation. People can no longer afford the $1 million plus property if they're renting it or owning it. What do? They go and sort out affordable accommodation. So when the top end's coming down, the bottom end continues to go strong, just like what happened in these markets. So this one is probably our fourth pick, but I stagnate them in a line. So every year that comes past, we're buying in the next best market. But in 2005, it had a little bit of soften in by 2%. I like buying in soft markets anyway. I like when markets going down because that's when you can get cracking deals, and the sales agents just try and push the sellers to let it go. And when there's lots of pessimism in a market and stuff is sitting around, that's when you can really work out who needs to sell and get cracking deals. Anywhere between 30 to 100,000 less than bank value that we pick up typically. So you're making your equity on day one, you can refinance it within 6 to 12 months and you can go again. You want to buy in suppressed markets. If you buy into a booming market that's going gangbusters, you'll pretty much overpay and you hope and pray that it'll continue to keep growing and go past where you bought it. So we don't buy at auctions. I've never bought one property at an auction. If you're buying it at an auction, you're buying in the wrong market. Your auctions are designed for creating emotion within buyers. They only really work in booming markets in order to drive top dollar. Always try to sell it at an auction, but never buy at an auction. If you're buying at an auction, you're getting the market wrong right from the get-go. I've never bought an auction and I never intend to buy at an auction. You always want to buy private treaty or off market when they've been sitting around and it's a stagnant market, and know where the market is heading rather than getting into a market that's already booming. You're too late by that point. Here we are, this one. So, I mean, this is a couple of years of slowdown, but more or less it is a solid, stable market to invest in. And this is one that we're keeping an eye on. We've been buying it, provided we get the right price. this market. We've been buying in this year for, I mean, sub 350 grand. As you can see, the medium is touching nearly 500. I'm expecting this market to soften this year and potentially in 26 as what it did in 2005 and 6. But as of 2007, look at that substantial growth. Go on, gangbusters. So that's why we're sowing our seeds now in the soft markets in preparation for the future growth runs that they are set to have based off the 18-year land cycle. So see this? This is what I like to see. A few years of soft. You want to sow your seeds in the soft markets in preparation for the future growth market. Look at that. Bang. So we like to plow in here. As Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. Everyone's greedy of Townsville, Perth, Adelaide. Everyone's plowing into these markets, Brisbane, thinking it's going to go on forever and never does. It only ends in tears. So be fearful when others are greedy. So be very cautious. And we're no longer buying in Queensland. We're not buying in Perth or Adelaide. We're buying in suppressed markets that are primed for the next growth run because everyone is pessimistic. Everyone's fearful. Everyone thinks it's not going to go on forever. But the soft markets end up turning into the bull runs. And once they start going gangbusters, that's when we look for the next suppressed market. We're always a couple of years ahead of the herd. And then everything I've bought always typically goes up 100 to 150% within 5 years because we buy it towards the end of the trough, right before it goes through its growth cycle. So this is getting me super excited. We've been buying here in preparation for the next growth run in the years ahead. So if that resonates with you, if you want to buy in markets in preparation for their future growth run and set yourself up, not overpay, get property for well under half the intrinsic value with solid cash flow and solid growth, which is yet to materialize. But once the growth cycle commences, you'll wish you bought multiple more properties. I remember back in 2018, 2019, we were buying a lot around Brisbane. People were so pessimistic of Brisbane 2018, 2019. We're picking up units for 150, 200 grand. These days they're worth all 450 plus. We're buying houses in Brisbane for 250. Now they're all going for 600, 700. So people are comparing Brisbane to Sydney. They think it's going to go on forever because of the Olympic Games, all the infrastructure. Don't get me wrong, infrastructure is great, but it's like the icing on the cake. You don't invest solely for infrastructure and investment from the public and private sector. That's the icing on the cake. You need to bake the cake in right from the start in suppressed markets and let the market do the heavy lifting, the land market that is. And then if they build infrastructure, then happy days. That's just icing on the cake. But you don't buy into overheated markets like Brisbane, Townsville, and Perth right now because of infrastructure spend. That's getting in too late. Anyway, hope that resonated with you. If you need help, if you want help building a sustainable property portfolio, I've done it for myself and many clients. All the clients I'm helping these days are killing it. I've got half a dozen to a dozen clients now on their third, fourth, and fifth property, and they're all less than the age of 25 years old. Happy days. If you want help building a sustainable property portfolio using our strategy, using the framework of the 18-year land cycle, or if you've already got burnt and you think you've bought something in an overheated market like Perth, if you bought something in Perth in the last year or two, or Brisbane, or Adelaide, or Townsville, or regional town that's dependent on the mines, reach out today before the market turns, before it's too late, before you end up in negative equity. Hope that helps. Get in touch today. See you on the next one.